Welcome to the daily update, where I'll go over the action in the market for Tuesday, April 1st, and then we'll see how things look for Wednesday, April 2nd. Had a little bit more of a bounce. It was a pretty choppy day. Didn't see an awful lot of conviction. There's still all this apprehension going on about the tariffs that are supposed to kick in, both on the 2nd and on the 3rd. Any last minute negotiations, what the tariffs are going to actually mean to the economy and just to individual businesses. And there's just still lots of things going on. And so that makes the market apprehensive. We're not really seeing much of an improvement with the growth to value ratios, a little bit, but we need to see a lot more than just 1 or 2 days. We need to see trends that really either show that it's getting better. The trends before this, after Monday's session, seem to show that things are getting worse, even though we had a strong intraday move. It's just really muddy right now. And so you have a lot of apprehension about getting into the market. So, right at the open, we had a lower open and prices initially fell. We got down below the daily pivot at 55.76. Then we saw a bounce. We got back above the daily pivot, above the unchanged level. Then we hit resistance at 56.50, another round number. Then we went back down below the unchanged level. We actually dropped below 5,600, and then we saw some late day buying that took prices back above the unchanged level to close positive. So we were up 0.38% on below average volume. We're back to that again. We saw the high volume in Monday's session. That was the last day of the month and the quarter. Now we're kind of going back into this below average volume type setting. We are still negative in the short and intermediate term and mixed in the long term. Interest rates are actually coming down. They fell. That doesn't seem to be giving much support to stocks. It's all about these tariffs and what are the ramifications going to be from that? So some comments. This tariff thing just keeps going on. And of course, a lot of folks have an opinion. They make these dogmatic statements about what's going to happen. But at the same time, there's so many variables out there that nobody really knows for sure. And we did have a pretty good day with mega caps and growth, but we're not really seeing a general shift over. And the VIX is still above 20. We're at 21.77. We don't have anything that's oversold in the short term. We just have the Arun in the intermediate term. So the market is not really showing much conviction, either up or down right now. And the non-confirmed Hindenburg Omen, well, the 31st has come and gone, March 31st, that is, and we didn't get an additional spike. So it's now off the books. We'll see if we get another one at some point. I know the perma bears are going to be out there saying it's still on the books and they only treat one spike as that's the end all right there. But no, according to how it should be implemented the right way, we need two spikes. We only got one, and that was at the beginning of March. Then it has to have another spike within 20 trading days, and that did not happen. No change to the overall scenario. The Fed's really kind of laying back right now. Jerome Powell will be speaking on Friday when the employment situation report comes out, so that could easily come back into focus. The dollar was up, interest rates were down. We're at 4.16% with the 10-year yield, where we had been at 4.25%. We're still extreme negative with sentiment. We're down at 19 now. Even with the update, we fell. We had been at 21. Now we're at 19. And this just kind of shows that folks are pretty hedged right now as far as these different indicators that we use to gain some insight as far as sentiment. And there's really not much more room to fall from a sentiment perspective. I mean, we could go to zero, but anytime we're under 25, that means we're already extreme. We're still inverted with the 10 to the 3 month yield curve. The 10 to the 2 year, that's still doing fine. It's not inverted. We're still negative with our trend. The ADX is starting to turn back up, though. It's not quite back above its moving average yet, showing that the trend could be getting stronger. And even though we had an update, I'm just keeping the bias at mixed because there's really not any conviction, at least in Tuesday's session, that really played itself out. And for the most part, I'm keeping our momentum at negative because we've been under pressure quite a bit lately. So the economic reports that came out, we had the final reading for the global US manufacturing, and it came in up over 50 at 50.2. That shows slight expansion. The last time we had the report, it was at 49.8. That's under 50, showing contraction. This was the big one in the ISM manufacturing at 49. That was weaker than the 49.8 they had expected, and it's also under 50. So now we're back to seeing contraction in the manufacturing area. And then decelerating activity, rising prices, and weakening employment for the manufacturing sector. It's the kind of a mix that will stir talk of stagflation, which means you have super high inflation with no economic growth. And that's a word that gets thrown around. I usually mention it in the weekend video when we look at a long-term chart of inflation and compare it to what's been happening now. JOLTS job openings came in down from the previous reading. We had 7.568 million. Last time it was at 7.762 million. Construction spending was actually up more, up 0.7%. They expected it to be up 0.4%. Last time it was down 0.5%. So here's the chart of the ISM manufacturing, where the total is coming down. It's under 50. That shows contraction. Also, the orders are dropping off. That's the yellow line. We saw a contraction there. Then you look at the prices and deliveries, where prices are going up. That's inflationary. Deliveries actually ticked down a bit there. And then exports versus imports. Exports, that's the blue line coming down. Imports, yellow line, also going down. This could be tariff related as well. And then looking at the month over month change where we did decline and we're below 50. That's the real takeaway. But even when things were so-called looking better, we were still under 50 with manufacturing because that's more of what the US economy is like now. 50, 60, 80 years ago, the US economy built things, they manufactured things. Now it's switched over to a service type economy, and we'll be getting that report later. And most of the manufacturing takes place in other countries, and that's why this trade war is kind of a big deal. Then looking at the job openings, really dropping off from the previous reading that we had, and construction spending, it ticked back up just a little bit and is still above zero. This is on a year over year basis. Then when you break it down into residential, that ticked up a little bit as well as non-residential on a year over year basis. And month over month, we were negative in the previous month. Now the spending actually went up. All right, then looking at our weekly version of the overbought, oversold composite, we're way down here at 23. We're oversold when we drop below 25, but it doesn't really seem to matter right now. It's not really giving us much of a bump up because we're seeing really negative readings in a lot of different areas in sentiment here with this chart and other charts that we see, but the market is really apprehensive to do a lot of buying right now. Then a bad March could mean a better April. Now, maybe the context is a little bit different, but March in 2020, this was the whole COVID crash in March, and then we bounced up out of that in April. That could be skewing the results a little bit there because that was such a weird situation. But it seems like life is weird now. We deal with weirdly strange things that are, uh, for the most part, unprecedented. And so the market's not quite sure how we will react. But quite often, the average has been when March is difficult, April tends to do better. Then looking at the declines that we see in the S&P, when it declines by about 25% around economic recessions, yeah, the word recession is being flown around from time to time, and that's not good for the overall stock market. But we're not there yet. We might get some more insight on Friday when we get the employment situation report. If that stays strong, then the likelihood of a recession really diminishes. And the forward PE ratio is still high above 20 when we take the aggregate together. And then the equal weight is more fairly priced coming in at 16. We still use that 10, 15, 20 scale. We're above 20 with the total reading, so that's expensive. When you take out the really big companies, then we're more fairly priced. We're right around that 15 level. Then this, you might want to pause and look at this. It says sensitivity of the returns for the S&P to earnings per share and PE scenarios. This is what does it look like for, as far as earnings at $220? That's more of a reading for the whole S&P 500. And if we're at 22 times, then that's where we should be with the S&P. Then if we want the high end coming in at 20, that would put us at 4,400. If we get down to 18 times earnings, that's 3,950, and it just goes down, down, down from there. If the earnings are looking better, then we see less damage. If the earnings are even higher, then we actually see some positive things looking forward, but it could also turn more negative to get under that 20 level for the PE ratio. Uncertainty really high right now as far as economic policy. Folks are just really confused, and it's being borne out by this chart. Then, under the new tariff baseline, the year over year core PCE inflation rises to 3.5% this year. That's what Goldman Sachs is figuring here. That's the dark dashed blue line here. And then, if there were no tariffs, they would expect here that we would actually get down to 2%, but nobody really knows that for sure. There's all these different things that could come flying in to change this, but it could even be worse than what's being projected here as well. Recession probabilities, Goldman Sachs is bumping it up to about 35%, where the Bloomberg consensus is right at about 30%. And gold funds, a lot of people are getting into gold right now. That's what we see over here on the right-hand side. That's what people get into when they're worried about inflation, when they're really uncertain about things. And that's a precious metal that you can physically have, and it always has been worth something. It'll always be worth something. And so that's where people tend to flock to. And this is just showing how the S&P has been underperforming the rest of the world. Yeah, Europe's pretty strong right now. Emerging markets are in uptrends where things in the US have been struggling lately. Didn't spend any time on Twitter. Here's the intraday chart where we had a lower open and then immediately went down below the daily pivot, but then we're able to get back above it. We went positive. We stalled right at 56.50. Then we dropped back, went negative. We did see some late day buying going into the close, and that's usually a positive thing. We'll see if there's any carryover into Wednesday's session. Here's the intraday chart. We're a little changed in the initial overnight session, and we started off looking a little more negative and then positive with the futures, and then we really dropped down. Then we had the open, and then the above and below the unchanged level. Not an awful lot of conviction. Very choppy right here. And we're still seeing this with the red line above the blue line. That means that value is outperforming growth. We want the blue line above the red line, although they're on different scales, and we want both of them, especially the blue line, to be going up. Not much of an improvement here with the growth to value ratio for the S&P, although it did come up slightly. End of day, growth was up or value was down for the large caps. It was up more for the mid caps and positive for the small caps where it was negative. So a little bit of bounce in the growth area, but nothing to really change things when we look at our end of day charts. Ticked up a little bit here with small cap growth to value, but still well below its 200-day moving average with the ratio. The same thing with the mid caps and even the S&P growth to value. So not much of a big change there. Ticking up here, but well below the rainbow when we look at the growth to value ratio between these two ETFs. A little bit of a tick up with discretionary to staples, but nothing that really changed the overall climate here. And we're starting to turn up in the short term with the ADX. You can see the ADX is turning back up. It's not quite back above its moving average yet. If it crosses above the moving average, that means the trend is getting stronger. And in this case, the context is negative because the red line is above the green line. and we're turning back up, but not above the moving average with the intermediate term. And this is the chart that I really focus on. I use the short term to try to get a little bit of leeway or foresight for what might happen in the intermediate term. And then we use the long term to see, okay, how is that? But I only show that over the weekend because it's based on a weekly chart. But this is still negative here. We were back to below average with volume, as we can see here with this. We ticked up in Monday's session, but now we're back below average here after Tuesday's session. Sentiment is we're still above 20 with the VIX, even though it ticked down just a little bit. We're dropping off just a little bit with the VIX of the VIX, which is typically what happens when the VIX declines. We're starting to turn back up here, but we're not quite there as far as the momentum for the VIX. The MACD hasn't quite crossed back above the moving average. We came down with this fear gauge and we came down with this other fear gauge. So actually, no, this went up a little bit. It's hard to read when there's just a little tick right here, but it actually increased slightly. A little bit of a contradiction there. We're still going down overall with the risk on to risk off ratio, which is more negative. We want this to be going up in a more positive environment. Keeping an eye on the spread between risky and not as risky bonds, this continues to drop, which means fear is increasing, and that could be negative for the markets. Came down with the daily chart of the equity put call ratio. So we're coming back down with the 5-day chart and just ticking a little lower with the 10-day chart as well. Coming up, it's still below the band here with volatility risk premium. This is another fear gauge that we look at and just not, it's showing a bit of an increase in fear, but not really high readings currently. Still holding up okay with the advanced decline line, just kind of going sideways, seeing a little bit more chop here based on volume, depending if they're buying or selling the mega caps, because that produces a more of a move in the volume indicator. And we're starting to roll over with the 5-day chart, and we're going down with the 10-day chart when we look at the new highs, new lows. Just this had been an internal measure that we look at inside the S&P that had been looking better, but now it's starting to show some weakness. We're still positive here with smart money indicator number 1. We're above the moving average and going up. We're above the midpoint with our advanced decline ratios. And we're turning back up and crossing above the moving average with smart money indicator number 2. So that's positive. And we're back to positive here with the Chaikin money flow. The green histogram is going up and the red line's going up. So our 3 smart money indicators are positive. We look at another primary indicator, the vortex, it's negative with the red line above the green line. We're coming back up above the moving average here with the S&P. When we look at the advanced decline line, still below the moving averages with the NYSE common stock, mid caps, and small caps. Slightly above 50 here with those stocks above their 20-period moving averages. A little bit of an improvement there. But we're still negative with the 50-period moving average study, the 100-period moving average study, and the 200-period moving average study. Now we can see this a little bit better. These are the pivot points for April right now. And the cool thing is these are on the chart before we even get there. So nothing really all that telling here in that we bounced up and came up to the 200-day moving average and then came back down. This is still looking pretty vulnerable as a chart pattern. And then we've dropped to below average based on volume. Not much of an improvement. We're right around 50 with the 20-period moving average study, the 50-period moving average study, and the 200-period moving average study. No momentum really showing here. The Stochk RSI is slightly above the midpoint. We're slightly below the midpoint with the Williams percent R. No real conviction with the CCI 14 or the CCI 20. Nothing really showing here with the stochastics. Short term, right about at the midpoint, going down below the midpoint in the intermediate term and starting to go more negative with the long-term stochastic. So no real conviction with these charts either. Still negative with the force index, even though it ticked up a bit. The condition of the short-term trend, still looking vulnerable here. We were looking better and the lines were starting to turn back up. Now we're dropping down below it and the lines are starting to go back down. We're in the -1 channel with our standard deviations chart, so that's not extreme. we're looking a little more positive with the balance of power. We're above zero and going up. Still negative with the go, no go with the dark, deep purple lines here. And not really showing much conviction below the midpoint with the highest high, lowest low value chart. TTM squeeze is still positive. It's just kind of been humming along here. And another day or so, and if this keeps going up, it could actually turn over to blue, which would be even more positive. And we want to watch this, the percent from the closing high that was set on February 19th. We're still not there yet. We're down 8.32% from the previous all-time high. If we go above 10%, that's when the context is going to change because then we are in correction territory. Still getting a low reading here with the rate of change going back 50 periods, but doesn't really seem to matter currently. Standard deviation just a tick above the moving average. That's why I'm showing this here, but it has been coming down after we had been really moving. Now we're just kind of meandering around. Little bit of an improvement, but negative with the ease of movement. The Arun is still extreme negative. It ticked up just a little bit. It's our only extreme negative indicator currently. Slightly above zero here with the S&P McClellan oscillator. So we're kind of ticking back up based on price, but we're declining based on volume. And improving, but still below zero with the NYSE McClellan oscillator. So we're going down with the summation index for the NYSE based on price and volume. Turning back up a little bit with the Swindler Trading Oscillator based on price, but we're still flat to even declining based on volume. A mixed picture there as well. Momentum just kind of chopping around right now with the PMO. We're flat based on price, and we're actually declining a little bit based on volume. A little bit of an improvement with the PMOs that are rising, but really showing no overall conviction. A bit of an increase in the buy signals and turning back up slightly with the PMOs that are above zero. Then we're still negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR since the dots are on top. Still positive here with our short-term oscillator, the slope oscillator, turning back, excuse me, turning back up, but still showing some recent weakness here with the MACD, but that's still hanging on to being positive. So we're still positive in the short term with the slope, but we're rolling over a bit with the TSI. So these are not really in lockstep with each other in the short term. Looking okay here with the MACD. That's still positive. We're flat with the PMO. Still looking positive with the PPO. Positive with the long-term momentum oscillators. The Copic curve is still positive. Sean trend meter going sideways currently. Below 50 with the money flow. Above 50 with the ultimate oscillator. Above the moving average with unbalanced volume, below 50 with the RSI 14, that's intermediate term, and the RSI 9, which is short term. And still not seeing much of an improvement with the intermediate term trend based on 50 periods here. The lines are still declining, that's more negative. Still below all the plotted moving averages here. We have not been able to regain any of those. And the short-term moving averages just continue to decline. The bullish percent index for the S&P still declining. That's negative. We're declining with the NYSE bullish percent index. We were flat after really declining on Monday with the NASDAQ 100 bullish percent index. Still not quite down to this red dashed line with the mass index. That would signal some kind of a reversal. And since we mostly have been going down, the reversal you would think would be to the upside. But if we do get a signal here and then many days start to pass before we see price movement, that signal will become less and less relevant. But we are working off of a buy signal with the Pring bottom fisher, but it hasn't really done too much yet. We're still below this little mini rainbow here as we've been trying to go back up. Some of these lines are acting as overhead resistance. We're still above the 50% retracement level with the Fibonacci chart, so that support is holding. And we're still holding above this 55.75 level with this long-term pivot point. We're still looking more negative with the Heiken Ashi with the black candles. We're negative but pointing up with the Kegi chart. We're positive with the Renko chart, and we're turning back positive with the three-line break chart. So a mixed picture there. We had a couple of X's drawn in here, so that's somewhat positive. No signal is being generated right now. We had been seeing new O's drawn in. After Tuesday, we saw some X's. All right, long term, still below the midpoint with the 150 and 200 period moving averages. And we're negative across the board here in the short and intermediate term with all of our indexes, where the small caps are also negative in the long term. And positive with bonds based on price in the short and intermediate term. Commodities continue to be a positive across the board. The dollar is still negative in the short and intermediate term. The financials were down slightly, but then healthcare, that's more of a defensive area. What was encouraging about Tuesday is we had discretionary and tech leading, but we need to see lots more of this. Communication needs to kick into gear too. That's another growth area, but it was virtually unchanged. So we saw a little bit of green or blue right off the bat with the real estate having a bullish MACD crossover, and even though it ended up being down on the day, we read these from the bottom up. So the very first signal was generated right after the open. Then the S&P went down below 5,600, only it got that back later. The Dow dropped below 42,000. The Nasdaq was above 17.3, then below 17.2, then 17.4, 17.5. Really choppy day here. And Canada's up around the 25,000 level. The Dow is still having a difficult time getting back above its 200-day moving average, which is acting as overhead resistance. We're negative with the Elder's Impulse system for the diamonds. And the Nasdaq still not looking all that great right now, nor is the Nasdaq 100. We're negative with the Qs. We're looking at the Elder's Impulse system. The momentum is just barely hanging on to being positive for the Nasdaq 100. If it crosses below this line, that would switch the momentum to negative. And small caps just not really looking good these days, even though they were up 0.25%. And the Russell 2000 small caps also below 50 with the RSI. The momentum is rolling over to turn negative. We've seen a recent death cross here. We're negative with the Elder's Impulse system for the small caps. Mid caps, we're seeing a death cross here as well. And we are still negative with the Elder's Impulse system. Still below the 200-day moving average with the Wilshire 5000 as well as the total U.S. stock ETF. So not much of an improvement there. Financial sector down a bit below its 50-day moving average. The FANG index also below its 200-day moving average, even though it was up 1.3%. And these are the ratios that we've been watching. It's more positive if this ratio is going down. Lately, it's been going up with the staples to tech ratio. Apple was up almost 0.5%, getting really close to a death cross here below its 200-day moving average. Amazon also below its 200-day moving average, but up 1%. Microsoft already in a downtrend. It was up 1.81%. Google also below its 200-day moving average, up 1.57%. Meta coming back above its 200-day moving average, up 1.67%. Nvidia in a downtrend, up 1.63%. Tesla having a hard time getting back above its 200-day moving average. It was up 3.54%. And then Netflix still dealing with its 50-day moving average, just slightly below. Still looking at a little bit of a strength here with the correlation between US and world stocks, where we're flattening out after declining with the long-term correlation. World stocks have been holding up better than US stocks so far in 2025. Oil is still at the low end of the 70 range after it just was recently in the high 60s. The dollar is still below its 200-day moving average. And coming down, this is actually rather encouraging. We see interest rates coming down and we're going up here based on price. We're still inverted with the 10 to the 3-month yield curve. We're in this red area. Not really much of an improvement with our growth to value ratios. When we look at the Qs to S&P, a little bit of a tick up here with discretionary to the S&P, a little bit of a tick up, but below a declining moving average when we compare large cap growth to value. So we're under the moving average with the large caps, mid caps, and small caps, even though they all ticked up a little bit. This is still declining, which is negative when the S&P is underperforming utilities. And this is also negative where staples are outperforming the S&P. We want this ratio to go down. Lately, it's been going up, even though it declined slightly on Tuesday. So what's our outlook? We're still negative in the short and intermediate term because we're below the 20 and 50 period moving averages. We're mixed in the long term. That long-term support is still holding for right now. We're going to get the MBA Mortgage Applications Index. We get that every week. The ADP employment change and factory orders will be coming out. And then the reaction to these tariffs and what's going to happen there. Here is a look at what will happen on Thursday. Kind of an important day. We'll get jobless claims, which we'll get every Thursday, and we're going to get ISM services. Then the big report is going to be on Friday with the employment situation report. Here's a look at the economic calendar here. Seasonality is quite positive for April 2nd. Positivity, oh, that's good. But going back to 2002, April 2nd tends to be fairly positive, even positivity. Okay, and here, but then when you look at it after an election, we don't really see positive seasonality. We just see it with the solid lines here when they take everything together. Oops, hit the wrong button there. So the warning signs were still negative with the McClellan oscillator and summation index for the NYSE. The Swindler Trending Oscillator, it's mixed, but and it's trying to turn up based on price. It's still flat to declining based on volume. The parabolic SAR is negative. The bullish percent indexes are negative. The moving averages. We came above 50 with the 20 period moving average study, but none of the other ones really improved. The ease of movement is negative, as is the money flow, and the vortex is negative. And then the long-term special K chart continues to be negative. On the positive side, we're looking a lot better with our three smart money indicators. Above the moving average with accumulation distribution, we're looking positive with the Chaikin money flow and the Chaikin oscillator, and the growth to value. Still looking like they are in an uptrend longer term, but they're all underneath their 200-day moving averages. And we're positive with the S&P McClellan oscillator and summation indexes, just slightly above zero. The oscillators are still mostly positive, but if we see more weakness, that could turn pretty quickly. The copy curve is still positive. The financial sector is still positive. I didn't show up, but the bank ETF is still below its 200-day simple moving average. And the ultimate oscillator is positive. It's above 50. And the momentum for the NASDAQ 100 is just barely still positive. So our conclusion, no real changes here. We're negative in the short and intermediate term, or we're mixed in the long term. That's what we're seeing in the short and intermediate term with really nothing extreme one way or the other. And we continue to be mixed in the long term. Thank you. I hope you found this helpful. Have a really good day on Wednesday, and I will talk to you in the next video.